Hello, everyone, and welcome to 4C Markets Podcast. I am your host, Alejandro and Serhii. As always, I have my co-host, Serhii, here with me. Serhii, how you doing today, man?
All is great. I think today we have a really interesting topic. Today we will be talking about Warren Buffett Indicator and how can we do interesting things with it. So Alejandro, what is Warren Buffett Indicator? Can you tell to our audience why do we need it?
Yeah, okay. So the Warren Buffett indicator is like super interesting, right? Because like I'm saying, Warren Buffett, anyone who knows anything knows that Warren Buffett, the Oracle of Omaha, he just makes like amazing investments while he was running Berkshire Hathaway. He's passed on the rail to someone else now. And he came up with the Warren Buffett indicator, which basically says what is the value of the stock market in comparison to the gross domestic product of a country, right? So in the United States, you have something like $40 trillion worth of GDP, gross domestic product. And then the stock market is worth nearly 70 trillion. So how do you measure that? Basically, people are saying we are willing to invest double the money on the companies in the United States than what the actual gross domestic product is, right? Now, is that a bad thing? Well, when people invest in something, they are investing in the future of the company. Like you're not investing today expecting the price to stay stagnant. You're investing today expecting that this price of the things that you bought will go up. And how do these prices go up? Well, the companies have to create good revenues. They have to have monetary discipline. They have to show that the earnings per share are performing well. And when you start to look at the size of the companies in the United States, where you have some companies that are already worth over $1 trillion in general, then you start to understand why the market capitalization of all of these companies coming together create a Warren Buffett ratio of nearly 2.2 or 2.3 times, right? So we do have some interesting things to show. Like if we look at this one, this is the Warren Buffett indicator. And here it says that it is strongly overvalued. And this is what I was talking about earlier. I think I said 40, but it's actually like 30, 31. I remember the numbers incorrectly, but I was correct on this one, nearly 70 trillion. So why does this matter? Well, if we are looking at the gross domestic product and we are saying that a particular company is worth a certain amount of money and you aggregate all these companies together and you come up with 70 trillion, but the country is only producing 31.5 trillion, is that a bad thing? Not necessarily, right? Because you have to do this in comparison with other companies, right? Other countries. The reason why the companies are worth more is because people put more value into it. Less risk, more chance of growth, better stability, less monetary risk. So you can look at, a country that has currency that is not as stable as the US dollar, for example, and then you can go and put your money on there. And then all of a sudden, if you're investing in euros in a company that is managed in Brazil with reals, and then there's a lot of fluctuation between the real and the euro, that's going to cause the price of the company itself to fluctuate, and this get a little bit too technical, but the point is that only because we see that the Warren Buffett indicator tells us that people are valuing the aggregate of the companies in the United States as double the gross domestic product and people are throwing a red flag on it, I would say, well, look at the context. This is made up of two numbers. One is the gross domestic product, and the other one is the overall market capitalization of all the companies. You take these two, you bring them together, you end up with a ratio, right? One over something else is a ratio. And what this number is saying, people around the world, right? Because it's not just the United States, people around the world are valuing the companies in the United States. And they're saying the companies here are worth more than the total gross domestic product in 1 year. Well, why? Well, because they're investing long term. They're not investing for 1 year, right? Like if you look at retirement pension funds, they're investing on the retirement of people. So what's the risk? The risk is that if the companies that are being invested on don't continue to perform as well as they have been investing, people may slowly start to shift their money out of the United States stock market and putting it into other companies. But because of the natural rotation and the seasonality of companies, this basically means that when people take the money out, the price of the stock will drop. So that means that when the price of those stocks become devaluated and people start to see that these companies are worth more than what is being paid for them, right? This is called the PEG ratio, price earning growth. It's dropping. That means that the price is dropping, but you still have all the other parameters still the same. Other investors will come and put money into it because they will see an opportunity. So I personally don't see this as a big risk, but I do think that we need to keep an eye on it. So how does this work? Well, if we look at the total domestic market cap against the GNI ratio, which is the gross national income, then we can see that over the years since 2022, it's been fluctuating every 6 months, right? So in June is when it's at the highest, and then in December it goes back to the lowest, right? June again 172 for the year 2022, and then on 2023 it shifted. In June it went up, and then in December it went up, and then it continued to go up until we got back to June 30th, and it dropped down to 209. So what happened in June 30th, right? Like what happened in June 30th last year? If anyone was paying attention, this is right around the time when all of the tariffs that were put in place by our current president, Trump, he was basically saying, we are going to put tariffs on everything. And then what happened is that the prices of the stock started to drop. Well, when the prices of stocks start to drop, the overall market capitalization is going to drop as well. And that's going to cause this ratio to go down. So is that a good thing? Well, that just means that you can pick up the stocks for cheap, right? Basically, like what happened on March 30th, that was like the lowest point of the S&P 500. Anybody who bought on the 30th of May probably made a profit on pretty much anything they put money on. And that's how you can use the Warren Buffett indicator, right? Use it as a cautionary tale. Take a look at the overall market, not just how it measures up against the United States, but see if it's fluctuating in other countries. If you want to put money in the United Kingdom, for example, it's at 98.05, right? And it's held pretty stable over time. It's not growing like the US. So that basically means that people are seeing that the GDP in the UK is worth what the stock market is worth. Does that mean that there's potential for growth in the companies? Perhaps. But then you have to look at each individual company. What people are saying is that in the United States, they're going to be willing to invest more money because they believe that the companies will flourish. That's my interpretation of it. What do you think, Serhii?
Yeah, this is really interesting. Basically, like given the time, so how much years you basically value your stocks versus GDP of your country. It's like pretty interesting interpretation. And what about say total value? What do you think? Because as far as I know, like the top previous value was a .com crash, which was like 211% and it crashed everything. And like the lowest was probably 48% at 1980s. So does the actual value itself mean something? Like, can it be predictor for some future events like overvalued, overpriced?
Do do you have the do you have a chart? Like I remember you mentioned that we could show a chart, right? Can you share your screen so that our audience can see it?
Yep, I can do it. So basically, this is it. This is screen.
Yeah, it's showing. So this is when you have to look at the individual companies, right? What was the dot-com crash? Well, the dot-com crash basically happened that if you went and you put in a .com on any company, they would get money. People were not looking at the fundamentals. People were not looking at the market itself. If they had clients, if they didn't have clients, if they were selling product or if they were just getting started. So this particular .com affected one industry, and then it took down the entire industry because everybody all of a sudden started pulling money from the stock market and trying to keep it safe. And this was at 2.1. Now, what do we have today? What is today's bubble? Today's bubble is AI. You slap AI onto a company, and all of a sudden this company just takes off, right? Like their valuation becomes impressive. So first of all, we're gonna change our name to ForcingMarkets.ai. And then secondly, no kidding, we're not gonna do that. But secondly, you have to like put that into perspective. Because one of the things that can be said about this is that you have to have a cautionary tale. So right now we know that AI is driving everything. Like if you look at just the very top companies worth over $1 trillion, if we remove those companies in the technology sector, then this ratio would drop significantly, right? So the majority of people are investing in technology because they believe in the future. So what do we have in upcoming? We have the SpaceX IPO. We have the OpenAI that just submitted paperwork to the Federal Exchange, the FTC, Federal Trade Commission, in order to go public. So this basically means that all of these companies are going to try to get a lot of money from the market. So now it is expected that when Elon Musk goes public with SpaceX on June 12th, he's going to be pushing out about $80 billion worth of stocks. The outstanding shares that are going out, I'm not sure what that's going to be, but they are expecting that the initial IPO, the initial public offering, is going to be something like $200, right? If you do the math, you'll probably be able to figure out how many outstanding shares that is. If we compare that to the .com, well, back then, when we had the .com, you had all of these companies that were, making money out of this. And one big one that, just like skyrocketed and then plummeted was AOL, right? America Online. These guys went all the way up to like $300 million worth. And then at the .com, this was one of the biggest losers, right? These were one of the ones that lost the most money. But then all of the other companies that managed to wither the .com, like Microsoft and I think Google went public in 2007, so they were just growing when the .com happened. All of these companies still flourished, right? And this is what we need to take into account. There is the people who run the companies, the people who invest in the companies, and the people who make the companies actually grow. Now we have this AI boom happening at the moment. Maybe there will be a bubble on it. So we have to be careful. We have to make sure that we're not all invested in AI. We have to try to make sure that the companies we invest in are the companies that will be able to withstand the fluctuations that will happen. So what do I think? I think Nvidia will do it. I think micro units is super overvalued right now, but it's still going strong. So people still believe in it. I think Seagate, STX, is also going to be one of the companies to be keeping an eye on because all of this deliver hardware. And at least right now, AI still needs hardware. Maybe in the future, it will be pure energy and then it will not need any hardware. But until that happens, hardware is going to be needed for AI. And as long as we have this big push for AI to help us on our everyday life, we're going to need to continue to see that these companies that have very large market capitalization will continue to grow. And as long as they continue to grow, we're going to continue to see this Warren Buffett ratio increase because the GDP is not going to be able to keep up with the amount of money people will be dumping into the AI infrastructure, especially if we see SpaceX just, skyrocket as is expected to.
So interesting to realize that a couple of companies are responsible for all of this, like growth, the whole indicator for the whole economy. It's really interesting.
Yeah, I know, right? It's one of those things that you just like when you start looking at the economy and the way things work. I mean, these people employ millions of individuals combined. They have a ton of money and a ton of resources, and it's the way that we are, pushing, right? We're pushing infrastructure, we're pushing cooling systems. Now, one of the big things is that they want to put AI servers in outer space in order to get them to be cooled by, just the natural coldness of space, and then also to be energized by the sun. So who knows? Maybe we'll come up with a Dyson sphere pretty soon, but it will be like wrapped around the Earth instead of wrapped around the sun, right? For anyone who doesn't know, a Dyson sphere is a mass that can be placed around an energy source like a star, and it can be utilized to provide endless continual power to the neighboring planets, in this case, Earth. But, that's a whole other topic.
Yeah, it's a completely different topic. Very interesting one about civilization types. First,
Yeah.
second, and other orders. But yeah, I don't know. For space, like heat dissipation, I think it's the biggest issue. Will be because why not to look at oceans where you can just put to the ocean you have like the same sun wave energy, like you have heat dissipation through waves. and through
Yeah,
water.
exactly. And maybe that's what and maybe that's what AI will help us do. Maybe AI will come in and give us like these really good ideas that say, you could actually do this and it will create the energy output that you want without the carbon footprint that you're getting. And that's why I like AI. Like a lot of people are anti-AI. I'm not gonna say I'm like 100% pro. I'm still thinking that maybe Skynet is not a good thing. Terminator reference for anyone who doesn't know, but like Skynet, I'm like, okay, let's stay away from that. But at the same time, we need to look at what computers did for us when we went from horse and carriage to automobile. We were able to explore so much more than we could do before. When we went from human computers, because for anyone who doesn't know, a computer was actually a person who was able to compute very quickly and do mathematical calculations. And then we have computers, which is what we think of now, which is like a desktop computer with a PC and so on and so forth, right? Once we receive laptops, we're able to become mobile and then do our work from anywhere. So we don't know where AI is going to take us. Maybe we'll end up with a cube, like a little cube we carry in our pockets, and that's how we do all our work, right? So I'm thinking that this is the frontier, like our renaissance, right? Like the next renaissance where we discover what we can accomplish through AI.
A great new tool, a great responsibility for humanity.
Yeah, man, definitely, definitely. And so because of all that, we're gonna start to bring some information about how LLM works within foreseen markets, right? Like large language models, how can we use them? And so we might have some episodes about this. We're still thinking about this. So this is something that we want to bring to our audience, basically for anyone who is watching. Our next episodes will probably include some more large language model information and about how it can be used when you're trying to get information about the markets in general and how this is going to allow you to make decisions regarding your investments. Yeah. And that's everything that we have for today. You got anything for us, Serhii?
Yep, subscribe, like, share, comment, and see you on the next episode.
All right, everyone. Thank you all for joining us today. This has been a really interesting episode. It's one of my favorites so far because this talks about the macroeconomy when it's compared to the stock market, right? Like the stock market is just a few companies here and there, but the macroeconomy really encompasses everyone and everything. So I'm glad we were able to do this episode. And that's everything we have for today. See you all next time. Today is June 1st, the start of a new month. And that's all we have for today. Thank you all for watching.